My name is Jeffrey Kennedy, and welcome to Trader's Classroom. This week we've been focusing on the four critical elements of a high probability trade setup: trend, pattern, momentum, and candlesticks. This week so far we've discussed trend and pattern analysis. Today we're going to be focusing on momentum. So let's begin. Now last night I gave you some homework. I wanted you to take a look at three price charts, and the first one was Caterpillar. Ticker symbol is CAT. And really what I wanted you to do was focus on recent price action in this market. Was this a trend-defining move, or merely was this a small counter-trend move within a larger downtrending market? As I've explained before, my style of trading is that of a trend trader. In an uptrend, I like to buy pullbacks, and in a downtrend, I like to sell bounces. Now, the overall trend in Caterpillar, as we've discussed, is to the downside. Prices are moving from the upper left-hand portion of the price chart to the bottom right-hand portion of the price chart. We have a distinct series of lower lows and lower highs. And if you look at recent price action, it's very choppy, it's very sloppy, it's very slow. Notice the prior move to the downside. Look how far prices traveled in a matter of, say, 4 or 5 trading days. Well, we did double, if not triple, the amount of trading days to the upside, but notice that prices didn't really travel that far. I consider this to be a small counter-trend move within a larger downtrending market. Now, if we were to maybe take another look at this, say, from an Elliott wave perspective, we could easily simply go waves 1, 2, 1, 2, clearly wave 3, most likely our first fourth wave counter-trend move. So regardless of how you would actually work the internals here, this move to the downside, again, the trend is down. An Elliott wave interpretation would certainly identify this sell-off as an impulsive decline, and within the impulsive decline, this is most likely a small fourth wave counter-trend move. So my attention in Caterpillar is going to be focused lower in the days and weeks ahead, most likely down to about, say, the 72 or the 70 handle. Now next, let's take a look at another price chart that I gave you for homework, and that was PXD, Pioneer Natural Resources. Again, how would you identify or how would you work with recent price action from a pattern analysis perspective? Is this a motive wave of some type? Is this a trend-defining price move? Or is this price move what we've seen over the last 2 or 3 weeks? Is it that slow, choppy, sloppy price action contained within parallel lines, all of which are key characteristics of counter-trend price action? Again, the larger trend in PXD is still to the downside. And the move here that we're working lower, most likely, again, an impulsive decline, waves 1, 2, 3, probably a 4. And more specifically, I would suspect within this price chart, what we actually have is a very small fourth wave contracting triangle. Waves A, B, C, D, and E, and it does appear, considering today's price action, that the pattern is actually complete. So we can most likely look for this issue to continue lower over the next, say, 2 to 3 weeks and put some serious pressure on the 110 handle. We also had one more price chart here, and that was Celgene. Now, the trend in this issue is clearly to the upside. Prices are moving from the bottom left-hand corner of the price chart to the upper right-hand corner of the price chart. Also, recent price action here, although a little bit decisive initially, it's very disjointed. It's very volatile. We have a lot of price moves, a lot of overlapping structures within the current decline here. I suspect this is most likely a fourth wave counter-trend move within a larger uptrending market. Perhaps 1, 2, 1, 2, 3, that would identify current selling as wave 4. So the two components so far that we've examined, trend and then also pattern analysis, specifically my style of pattern analysis is going to be, of course, the Elliott wave principle. So I'm naturally going to be looking for zigzags and flats and triangles or corrective combinations. That would be the WXY formation. But do we stop there? In my opinion, absolutely not. The field of technical analysis is very rich and diverse, and it offers a number of very reliable different tools and also disciplines that allow us to forecast confidently and, more importantly, trade the markets. So I tend to embrace more of a holistic approach to financial analysis as well as trading. So I like to utilize the different tools technical analysis offers to help have confidence in my current Elliott wave interpretation of the markets. So let's take a look at some momentum momentum tools, or some tools or some things that I look at to help me get an idea of momentum. Now, for example, on this price chart right here, this was a tool that we looked at. This is what I call the Kennedy trend ribbon. And essentially what you'll see in this slide here of Caterpillar is price action pushing up. We moved above the red line, up and found, say, resistance around the blue and green line, but we're still holding the black line. Utilizing this specific tool, this is what I consider to see a pocket trade setup. I like to see prices push into that, say, above the blue and green, but hold the black and red and then reverse. This signature that you're currently seeing here, certainly positioned with the QQE as well as the TDI. QQE stands for Quantitative Qualitative Estimator, and the TDI is nothing more than the Trader's Dynamic Index. Both indicators are derived from RSI, and I find that to be very useful. But this momentum signature here, looking at this price chart, certainly confirms, or at the very least supports my interpretation that recent price action in Caterpillar is indeed that of a counter trend price move, again, most likely wave 4 within a larger unfolding 5-wave decline. We can also utilize different tools, different momentum tools, for example. Now these lines here are nothing more than moving averages, a 7-period, 14-period, and 28-period. These are volume-weighted moving averages, so they're a little bit different than your normal simple or exponential moving averages. And what I like to do is look for a very specific momentum signature, because, again, moving averages do nothing but actually measure and monitor and follow price. I like to look for this transition here. Notice that early in the move to the downside, we had the short-term, intermediate term, and long-term. All three moving averages appear in the same color. And then there was a period of time where the short-term turned green. That is basically telling me that we have a short-term uptrend within a longer-term downtrend. We have the same condition occurring here. But now what you're seeing in today's price action is you're actually seeing all the moving averages move back in agreement, implying that the short-term, intermediate term, and long-term trend are down. This is exactly the kind of signature I would want to see, supportive of this, supportive of the idea that the recent price action we've seen in Caterpillar is indeed that of a counter-trend price move. Of course, we can look at MACD and MACD histogram. Because the MACD line and the signal line are below 0, this tells me that the trend is down. More importantly, the crossover of the histogram of the 0 line identifies this as a counter trend move within a larger downtrending market. And this is very important to understand. If you take a look at MACD specifically, both lines, the MACD line and the MACD signal line, actually fell below 0, say starting back in late June. Okay, this tells me that the trend is to the downside. When we have violations of the 0 line by MACD histogram, what that does is it identifies this advance here as a counter trend move within a larger downtrending market. We also have the same occurrence again recently. This is nothing more than a counter trend move within a larger downtrending market. Also, too, the fact that the momentum here was stronger than what we saw previously, but prices are below what we actually saw here. This is a momentum signature I precisely identify as either reverse divergence or what I sometimes call a slingshot. I've been working with this signature for really over a decade, but recently the MTA has adopted the terms positive and or negative reversals. Thank you to Andrew Cardwell, of course. Then we can look at, say, another price chart of Caterpillar utilizing the RSI and the stochastic. Again, the same thing. I like to see RSI move up into, say, the 50-60 handle. That tends to correspond nicely with counter trend moves in price. So we can now actually utilize RSI to confirm the presence of a counter trend price move. Typically what you'll find if you apply the range rules correctly, and the range rules were, as far as its use in RSI, were originally developed by Andrew Cardwell, and it's a very simple rule of thumb. In an uptrending market, whenever you see a counter trend move in price, RSI will move back into the 50-40 handle, hold, and then reverse. Conversely, in a downtrending market, if you see an advance in price, but RSI moves into the 50-60 handle and then stalls, that's a good indication or further confirmation that the move you're looking at is truly a counter trend move and not a newly developing uptrend. And we can look at some other price charts that I've actually put in today's PDF for you, looking at also Pioneer Natural Resources, PXD, and you'll see many of the same signatures that we've already discussed. Here, what we have potentially working in PXD is what I often call a zero line reversal. Notice the MACD line and the MACD signal line are both below zero. Meanwhile, at the same time, histogram is above zero, indicating that this is nothing more than a counter trend move within a larger downtrending market. Our in-depth Elliott wave analysis identifies that pattern specifically as a contracting triangle. And of course, we have the appropriate momentum signatures that we need to see in RSI. Notice that RSI is turning down from the 50-60 handle. Meanwhile, we also have stochastic reversing from the 50 line. This is what I call a zero line reversal utilizing stochastic, even though the balance point is 50. But other examples of that occurred here as well as here, again to the downside. We'll look at one more price chart. Here are our volume-weighted moving averages. Again, recently, the last 2 trading days, we're seeing the short-term, intermediate-term, and long-term moving averages, or what they represent, more importantly, again, turn back to the downside. I like to look for those interruptions, like here, and here, and here, and recently, and again here. All this does is identify a selling opportunity in the direction of the larger trend, which is certainly to the downside. And we can do the same thing, again, utilizing PXD and our trend ribbon here. Notice RSI turning down. So again, let me just go back and reinforce a very key or very important concept. Not only the importance of momentum analysis, but the importance of what technical analysis, the field of technical analysis, truly brings to the table. Technical analysis is a very rich and diverse field. It offers us many different tools, many different reliable and proven tools, as well as disciplines to utilize when we're making a forecast in any market, regardless of whether it's a currency, whether it's, say, the S&P 500 or gold or crude oil, it doesn't matter. Why simply stick with one discipline? As far as I know, and I've been doing this for quite a while, there's not a rule saying that if you practice Elliott, you can't do anything else. Or if you do point and figure charting, you can't do anything else. Or if all you use is RSI, well, if you use RSI, you can't use stochastics or MACD. There is no such rule. That being the case, I strongly encourage you to adopt a holistic approach to the market analysis as well as trading, because each of the tools that you utilize, if they're inherently different, for example, the wave principle is very, very different than analyzing a market utilizing RSI, and that's going to be very different than analyzing a market utilizing Japanese candlestick analysis. Because those 3 approaches are different, whenever they find agreement, then and only then do you truly have a high confidence and high probability trade setup. Now, when I join you next week, or when you join me next week, we'll be looking at another discipline, and that's going to be Japanese candlestick analysis, and that's going to be the 4th component of what I consider to be a high probability trade setup. Thank you very much.